Commodity-backed fiat. This refers to currencies that originally had their value directly tied to physical commodities, such as gold or silver, often through systems like the gold standard. Under those systems, governments promised that paper money could be exchanged for a fixed amount of the commodity, which helped build trust and limit excessive money printing. Over time, especially during major economic crises and wars, governments found this system too restrictive because it limited their ability to respond to economic needs. As a result, most countries gradually abandoned commodity backing in the 20th century, fully transitioning to fiat systems. Even today, the legacy of this transition still shapes how people perceive money, with gold often seen as a safe haven during instability. This historical shift is one of the most important turning points in modern economic history, as it allowed for flexible monetary policy but also introduced the risk of inflation if mismanaged. Pure fiat currency. This is the most fundamental form of money used today, where currency has value simply because a government declares it legal tender, and people trust that it will be accepted in exchange for goods and services. There is no intrinsic value and no physical backing behind it, meaning a banknote is essentially a symbol of trust rather than a store of material worth. The stability of pure fiat depends heavily on confidence in the government, the strength of the economy, and the effectiveness of monetary policy. If people begin to lose trust, the currency can quickly lose value. Governments can print more money when needed, which is useful during recessions, but doing so excessively leads to inflation or even hyperinflation. This balance between flexibility and risk is what defines pure fiat systems and makes them both powerful and potentially unstable. Central bank-issued currency. This type of fiat currency is created and managed by a country's central bank, which acts as the main authority over the monetary system. Central banks control how much money exists in the economy and influence borrowing and spending by adjusting interest rates. They also act as lenders of last resort during financial crises, helping stabilize banks and prevent economic collapse. Their policies directly affect inflation, employment, and economic growth. Trust in the central bank is critical, as poor decisions can lead to instability or loss of confidence in the currency. Modern economies rely heavily on central bank credibility, transparency, and independence to maintain stable financial systems. Without this structure, fiat currencies would be far more volatile and unpredictable. Digital fiat currency. This refers to fiat money that exists purely in electronic form, such as balances in bank accounts, card payments, and online transactions. In reality, the vast majority of money in modern economies is digital rather than physical cash. This system allows for fast, efficient transactions across the world, enabling everything from online shopping to international trade. Digital fiat relies on banking infrastructure, payment networks, and cybersecurity systems to function properly. While it increases convenience and speed, it also introduces risks such as hacking, technical failures, and dependence on financial institutions. The shift toward digital money has also reduced the use of cash in many countries, gradually transforming how people interact with money on a daily basis. Central bank digital currency. This is a modern evolution of fiat currency where the central bank issues a fully digital version of the national currency. Unlike regular digital money stored in commercial banks, CBDCs are direct liabilities of the central bank, meaning individuals could theoretically hold money without needing a traditional bank account. This can increase financial inclusion and reduce transaction costs, especially in countries with limited banking access. CBDCs also give governments more direct control over the money supply and allow for real-time monitoring of transactions, which can help reduce fraud and improve tax collection. However, they raise serious concerns about privacy, surveillance, and the potential for governments to exert too much control over individual financial activity. As a result, CBDCs are one of the most debated developments in modern finance. Fractional reserve-based fiat. This system allows banks to lend out most of the money deposited by customers while keeping only a small percentage as reserves. When banks issue loans, they effectively create new money, expanding the total money supply beyond the amount of physical cash available. This process is a key driver of economic growth, as it enables businesses and individuals to access credit for investment and consumption. However, it also introduces risks such as bank runs, where too many people try to withdraw money at once. To prevent this, central banks regulate reserve requirements and provide support during crises. Fractional reserve banking is one of the core mechanisms behind modern financial systems, but it requires careful oversight to maintain stability. Managed fiat currency. This type of currency is actively controlled by governments and central banks through various monetary policy tools. These include adjusting interest rates, printing or reducing money supply, and implementing policies like quantitative easing during economic downturns. The goal is to smooth out economic cycles, prevent extreme inflation or deflation, and support employment and growth. Managed fiat systems are dynamic and constantly adjusted based on economic conditions, making them more flexible than rigid systems like the gold standard. However, they also depend heavily on the skill and judgment of policymakers, and poor decisions can lead to long-term economic problems. Floating fiat currency. This currency operates in a system where its value is determined entirely by supply and demand in global foreign exchange markets. Factors such as trade balances, inflation rates, political stability, and investor confidence all influence its value. Floating exchange rates allow economies to adjust naturally to global conditions, which can help absorb shocks and maintain competitiveness. However, this flexibility also means that currencies can be volatile, with sudden changes in value affecting trade, investment, and inflation. Most major global currencies today operate under this system, making it a central feature of the modern international financial system. Fixed, or pegged, fiat currency. This type of currency is tied to another currency or a basket of currencies at a fixed exchange rate. Governments maintain this peg by buying or selling their own currency in foreign exchange markets and holding large reserves. This system provides stability, especially for countries that rely heavily on trade, as it reduces exchange rate uncertainty. However, maintaining a peg can be difficult and costly, particularly during economic crises or when market pressures push against the fixed rate. If a peg fails, it can lead to sudden and severe currency devaluation. Hyperinflationary fiat currency. This occurs when a fiat currency loses value extremely rapidly, usually due to excessive money printing, economic collapse, or loss of confidence in the government. Prices can rise dramatically within days or even hours, making money almost useless as a store of value. In such situations, people often turn to alternative currencies or barter systems to survive. Hyperinflation can destroy savings, disrupt economies, and lead to social and political instability. It is one of the most extreme examples of how fiat systems can fail when trust and control are lost. Parallel fiat currency. This situation arises when multiple currencies are used within the same country or economy at the same time. It often happens during periods of economic instability, where people prefer to use a more stable foreign currency alongside the local one. This can help individuals protect their wealth, but also weakens the domestic currency and reduces the effectiveness of government monetary policy. Parallel currency systems can create complexity in pricing, taxation, and financial regulation, making economic management more difficult. Regional fiat currency. This refers to a single currency shared by multiple countries within a monetary union. These systems are designed to simplify trade, travel, and economic integration between member nations. However, they require countries to coordinate their economic policies and give up some control over their own monetary decisions. Differences in economic strength between member countries can create challenges, especially during financial crises. While regional currencies can bring stability and efficiency, they also require strong cooperation and trust between participating nations.